Look at what we can expect from the local market with Stan Chamu from IG in Melbourne. Stan, futures still closed, so how's the risk currency space looking this morning?
Yeah, no, morning, Kate. It certainly does seem like we're in for a fairly positive morning at the moment. Most of the risk currency space has remained fairly buoyant. Of course, we did see this move triggered on Friday, despite that weaker than expected non-farm payrolls print. Of course, with the US Fed now tying its QE targets with numerical values for the unemployment rate, particularly, it certainly seems like any further weakness in the jobs market will definitely show that the QE is not going anywhere anytime soon. We also heard from the Fed member Bullard just saying that an unemployment rate in the low sevens may see the Fed consider ending QE. So with the unemployment rate actually ticking up surprisingly to 7.9%, as opposed to the consensus of 7.8%, it certainly does seem like they're a long way away from there.
Yes, Dan, but was that why we saw the gains, or was it because the historical data was revised up? So, I mean, was it good news is bad or bad news is good?
Yeah, at the moment it certainly seems like bad news is good. Of course, like the clip you're playing before, it just really does seem like the Fed and QE is what has driven this big move we've seen in markets at the moment. And if we are to continue these moves, we'll probably need to see this QE continue to feed through to markets and push equities much higher. At the moment, of course, we did also see some fairly positive manufacturing numbers from the US, that ISM manufacturing number, which showed a big improvement from what was expected. I think they're expecting 50.7, it came in at about 53.1. So such surprises, along with maybe not such a weak employment market, but it's just hitting that sweet spot where it's not weak enough to cause any reason for panic, but at the same time it's not strong enough for them to pull the pin on QE, and that's probably what we need to continue seeing for them to sustain this QE program going ahead. Of course, if we see ultra strong jobs numbers, then it will really alarm a lot of investors out there that maybe QE is coming to an end, and this might cause some weakness or underperformance of some sort in equities. But for now, I mean, it's really done a lot for the market. You look at the risk currencies, you look at the euro, it pushed through that 137 mark. The euro was looking very fragile earlier in the year, but it's really now got a bit of a boost. We've also seen some improving economic data out of the eurozone, particularly in the manufacturing PMI space, and that's really been one of the key performers of the past couple of weeks. That's the single currency, that is, and I think we've seen quite a lot of traders just try to ride that wave up. And that 137 mark might see a little bit of profit taking in the near term, but at the moment it certainly remains in a solid uptrend. Moving on to the Aussie dollar, that's probably one of the most interesting ones for the week, definitely the one to watch. We've got a lot of key data out locally. We've got the ANZ job ads and building approvals at 11:30. Now that will be closely watched and followed tomorrow by the trade balance and the RBA's rate decision. Of course, with the Australian economy, a lot of households' income is tied up to their property value. So with property values showing improvement, I think it was a 1.2% rise across most of the capital cities in January, it really does seem like we might start seeing a bit more confidence in the market. So as it stands, the RBA is largely expected to stay on hold at 3% and just reassess exactly where this economy is going in the near term, particularly with the property market seemingly improving. Hopefully it's not just seasonal, where it just shows some signs of stability in January and then structurally it hasn't really improved. Should we see further signs of improvement, then we can expect the Aussie dollar to possibly consolidate above that 104 level. But at the moment it still remains quite fragile, despite opening a bit higher this morning.
Okay, let's talk about the market at the open and some of the other factors that are going to impact it. At the moment, we're looking at some pretty nice gains, about 0.5%. Is that where you see it?
Yeah, we're actually calling it up 0.3% at 49.37 at the moment. Of course, this is on the back of that monster rally last week of about 2.1%. So it really will see increasing calls for correction in the near term, particularly as we approach that 5,000 mark, which tends to be just a psychologically important level as well. We've got a few big names on the reporting calendar as well this week, like Newcrest, Telstra. We've got Tabcorp, we've got Newcrest Mining and News Corp as well. So that might impact how the market trades this week, just in terms of sentiment out there. As the banks start giving some of their updates as well, this will be key for how the local market trades. But all up, we are expecting the resources to lead the market early. We're expecting BHP to trade at 38.15, which is about a 0.6% gain from Friday's close. The strength in the iron ore space is likely to be widespread, with iron ore prices ticking higher yet again to about 153.20. So that will probably be what will lead the market early, and then we'll have to, of course, see what happens with the defensive names, particularly with the yield plays, as they look a bit stretched at the moment after that big run from last week. Heading into 11:30, of course, with the building approvals being expected to be up about 1.1%. That could be a game changer should we miss expectations there, along with those ANZ job ads leading up to the jobs numbers on Thursday. So there's quite a few things to look out for there. But all up, it certainly seems like we'll have a positive start to the week.
Sounds like it, Stan Shamu from IG in Melbourne. Thanks for today.
Cheers, Kate.
Well, Chevron is blaming the high Aussie dollar and extra logistics for a $15 billion